Hello and welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm joined today by Matt Hodge, Morningstar equity analyst, to talk about mining stocks. So how have mining stocks fared in 2017, Matt?
Yeah, so 2016 and 2017 have been really strong years for resources. So been a couple of things. So China really pushed the stimulus in 2016. So you've seen debt grow pretty rapidly in China, so debt to GDP. That's what they've used to finance that continued growth. And over time, their economic growth has become even more reliant on the fixed asset investment part of the economy. So construction, building roads, building buildings, that kind of thing. So what we see now is you've got a whole bunch of commodities that are trading well above their marginal cost, so aluminium, steel making materials, so iron ore and coking coal, alumina, manganese, all well above. And Chinese supply side, coal as well. Chinese supply side disruption has been an important part of that as well. So what they're doing internally, and in coal and steel, they're big producers globally. So, conditions now are very, very positive for the miners, but we don't think that can continue forever, given the foundation that it's built on, which is around, pretty rapidly rising debt and continued investment in things that aren't generating strong returns in China. And the reason why I talk about China is China's basically half of the world's consumption of all of these goods.
And how does your outlook for commodity prices influence your opinion of a particular mining stock?
In general, we're most negative on the steelmaking materials, particularly kind of iron ore and coking coal. And we're kind of more positive on oils, more consumption focus. Needs to be replenished because there's natural field decline, which means you need capital, which means you need a price to incentivise that new investment. If you look at Glencore and Anglo, they generally sit on a high position on the cost curve relative to BHP and Rio, so they're more leveraged. So by extension, given that commodity prices are quite high right now, they're the ones that are most overvalued. The levered names are the most overvalued. As we see commodity prices coming lower, they'll be impacted disproportionately. Between BHP and Rio, it's really about the commodity mix. So there, BHP's got a greater exposure to oil, lesser iron ore. It's still significant, but Rio Tinto is really dominated by iron ore. It's got a bit of aluminium, a bit of copper. So given that, we think, of the four, that BHP is the best value, still overvalued within the group. But Rio Tinto next, and then the more levered names are most overvalued.